On February 28, 2026, Dubai's market experienced its first real shock in 17 years. Strikes on Iran, retaliatory missiles and drones on UAE territory, the Strait of Hormuz shut down, flights cancelled, thousands of people hastily leaving the Emirates. And anyone who has an apartment, a contract, or plans of buying something here is asking one main question: will Dubai's market pull through this time? And how fast? I live in Dubai myself and I have my own investment apartments here. Over the last month, I have spoken with agents who lived through the 2008 crisis, 2014 to 2016 downturn, and the COVID times. And in this video, we'll break it down piece by piece. What is already happening in the market? Which parallels with past crises actually work? What to do about rentals, about off-plan properties? And most importantly, which deals and at what moment is it worth closing now, and which ones are best to wait on? If you stick with me to the end, I'll share what I did with my own Dubai property and why. What has actually changed in the market over the past month? The first thing to understand is that it is not a crash, it's a freeze. Deals have closed, but they're going through. Prices haven't dropped yet. Agencies are working. Deals are closing. Yes, more slowly, with more difficulty, but they are closing. This is a natural reaction of any market to a shock. At first, everybody freezes, some panic, and others, on the contrary, become active. And with every passing week, you can see that more cars are back on the roads, parking spots at Kite Beach are disappearing again, people are adapting. Investors who can afford it have pulled their properties off the market. Nobody with a rainy day fund wants to sell cheap. Those with liquidity, however, went hunting. Like in any crisis, they're standing by and waiting for somebody to start selling at half price. And that's the first important signal. When the market actually crashed after 2008, the first off-plan launches only appeared 4 to 5 years later. Today, government developers are still announcing. Projects are being built, escrow is working, infrastructure is expanding. The Dubai of 2026 is nothing like the Dubai of 2008. The stock market. What the 2008 patterns show. Before talking about real estate, an important marker is the stock market. It is the first to react in any crisis. We saw this in 2008 and before COVID. Numbers for context. 2008, UAE stocks, banks like Emiratis and BD, dropped 70 to 80%. Before COVID, the same papers down 30 to 40%. Today, the banks introduced a cap of maximum daily drop. And if you look at UAE indices, you will see that most of falling stocks drop by 4.9% day after day. The exact same picture as in 2008, 10 to 15% in the first week, another 15% in the second week, and 5 to 10% in the third week. This doesn't mean that we are repeating 2008 one-to-one, but the pattern is still the same. And it raises the question, is this a buy-the-dip entry point right now? For stocks, possibly yes, but I am not sure it's today exactly. If you have a long horizon, a dollar-cost averaging strategy over 4 to 6 weeks in equal portions seems more sensible than going in with the full amount all at once. And we're waiting for the first positive news from the US and Iran as a turnaround signal. Rentals, where it has already dropped and what owners should do. This is the hottest block for those with apartments already rented out here. What is happening? Short-term and Airbnb dropped sharply. Tourist flow collapsed. Many hotels are offering discounts. Many host units have simply been empty for the past few months. If a building had, say, 10 furnished apartments for a short term, today there are 30. Hosts are massively pulling units into long-term, and long-term supply has swelled as well. For long-term, the picture is split. On the one hand, official reports for the last 3 months already show roughly minus 3% for renewed contracts and around minus 14% price drop for new contracts. These figures aren't catastrophic, but it's movement. On the other hand, tenants are asking to terminate their contracts early en masse. Some were laid off, some were fired, and some are simply uncomfortable and want a change of scene. What an owner should do: concrete steps that actually work. Keep your current tenants at any cost. These are the people that may have been with you for more than a year, and no one will pay you better this season. If a tenant asks you to shorten the term to 6 months, agree. It's better than to have an empty unit. Remove the early termination penalty in exchange for 1 to 2 months' notice. Peace of mind matters more on both sides than a formal black mark. Willing to give additional checks, 4, 6, 12. Give them, but only to verified tenants. On new contracts, try 1 or 2 months free internet, no commission if you're the owner without an agent, and reducing commission to 172 dirhams on a jari. If you go through an agent, try the top-up scheme. The agent doesn't take commission from the tenant. You, as the owner, pay them a fixed fee. That way, the unit rents out faster. Write smart clauses. A 12-month contract with monthly payment and the right of both parties to exit. Some companies hold a property management licenses for this. That way you are not locked into a depressed price for the long term. If you want us to take a look at your specific unit and establish what the right price is under the current market, how to rewrite clauses, and how to structure checks, fill out a form for a free consultation at the link in the description or just text us on WhatsApp. What's being bought right now and what to stay away from. If you look at the portraits of the current buyers, there are only 2 types in the market. The first, mortgage buyers. It sounds paradoxical, but on a falling market, it is them who become the most active first. The logic here is simple. They don't want to risk their own money, but when it comes to taking a ready bank approval and entering a depressed market, that's profitable. We can help you at any stage of the process here too, even if you don't have anything yet and don't know how it works. The second, seasoned cash investors who have known the market for 5+ years. They put requests in with agencies that sound something like this. I'll buy at minus 20 to 30% from market. There are plenty of such characters, but sellers are not yet ready to give such discounts. That, by the way, is a very good sign that the market is more alive than dead. Where smart money is looking right now? Ready property, the ready market. This is the main opportunity. Any crisis in Dubai traditionally first squeezes out the ready property from those whose checks start bouncing or who need liquidity. If the property is fundamentally good, we take it. Near handover off-plan projects from proven developers with escrow. The money is protected, handover is closed, catching a discount from the original buyer is a working strategy. What to stay away from? Fresh off-plan at launch in the current conditions. The market isn't the best place for bets 3 years ahead at this level of uncertainty. Commercial. This, it seems to me, is the most underestimated risk in the current crisis. Offices are a hypersensitive instrument. Back in COVID, they dropped much more significantly than residential. And back then, they were practically being sold for pennies. But on the other hand, it opens a huge opportunity to buy them well below the market. In the long run, it will pay off. If you want to understand at least the basic rules of the game in commercial, watch this separate episode. There you will see all the anomalous opportunities and pitfalls. Lessons from 3 crises: 2008, 2014, and COVID. Here, the parallels matter not for beauty, but to understand what specifically to look at in terms of timelines and forms of recovery. 2008, the scariest of them all. Back then, freehold for foreigners in Dubai was a very young phenomenon, just a few years old. There was no proper legislation. Many developers just simply ran off with investors' money. People lost money not because of the crisis itself, but because of the holes in the system. The crisis then got global. Phones were silent everywhere, complete disorientation. The state quickly learned from its mistakes. Escrow appeared, developer regulations, RERA, Real Estate Regulation Authority. Today, losing money on off-plan with a normal developer is practically impossible. 2014 to 2016. Also a freeze. Fewer launches, less interest in the Middle East, Iraq, Syria, the Arab Spring. Foreigners saw the region as one solid tension zone. Recovery was gradual, and the market truly began growing in 2018 to 2019, and this is an example of the slow recovery scenario. COVID. Inside the country, the feeling was much scarier than now. You literally couldn't leave the house, there were no spare spots at the hospitals, complete uncertainty about the virus. But we came out of it fast. Dubai was the first to open flights, masks and gloves were handed out, and the country was centrally vaccinated. They have and had money for air defense now and for the pandemic back then. What's more important is that the patterns of buyer behavior in the current crisis are very similar to COVID. The primary market suffers first. The most active buyers are resident cash holders, those who have been here for a long time and who had been waiting for a price correction because prices seemed inflated. They come out and scoop up ready properties at good prices. 2010 after 2008 was the point when secondary off-plan came back to life and buyouts among each other began. That is also when the word distressed first appeared in widespread use. And one more difference between the current crisis and COVID. The market isn't globally paralyzed. Right now, you can call Europe, Russia, India, discuss deals, run escrow. Back in 2008 and in COVID times, there was complete silence everywhere at the same time. If it's important for you to see in real time which distressed deals are coming to market right now and at what prices, just leave us a request in the form or write us on WhatsApp. This is the hottest opportunity in the market right now. Why Dubai's fundamentals will hold up. And it's not just faith, it's a set of specific things that you can see for yourself in numbers. The population has grown to 4 million residents in 2026, just permanent residents with Emiratis ID, excluding tourists. 19 million tourists traveled to Dubai by the end of 2025. A record. The Vision 2040 plan, doubling the population to 8 million. Budgets, infrastructure, public transportation, and roads are already expanding to accommodate this plan today. Every year there is a plus 260 to 300,000 new relocators, with only 50 to 60,000 units being delivered per year, which means that the structural housing shortage hasn't gone anywhere. Family communities, decent 2 bedrooms with a maid's room in green areas are worth their weight in gold. This isn't marketing, it's the arithmetic of supply and demand. I live in Dubai Hills myself and it wasn't so easy to find this house at a good price. 18 to 20% of the entire housing stock are simply piggy banks for large capital. Units that sit empty for years just as a way to store money. Low taxes, a tax-free zone, loyalty to capital, investor protection through escrow, and most importantly, the level of capital that came into Dubai after COVID. This isn't buy and flip with leverage like in 2008. These are Europeans, Indian families, Russian speakers with secondary wealth. For them, running back to London or Paris and paying taxes just simply makes no sense. That's why we won't see mass fire sales at any price. What I am doing with my portfolio, the strategy. In short, I haven't put a single one of my UAE properties up for sale. Why? The original strategy was long-term hold for income and capital growth. Time smooths out any fluctuations. If the property was fundamentally chosen correctly, it will recover. I fundamentally believe in UAE economy. When and how a recovery will happen. A realistic forecast. First, here are the indicators that we're tracking. The main one is tourism. As soon as full flights return to Dubai, the engine is going to be on, and prices will go up. Government developers, MR, Miraz, Dubai Holding, coming in with new launches. Distressed deals appearing and quickly leaving the market. If good offers are getting snapped up, it means demand has returned. Post-handover plans that Dubai came up with during COVID. Installments after handover. If such terms appear en masse again, it means that developers are ready to stimulate demand. Here are some scenarios by time frame. First, base scenario. Truce within a month or two. Return to February 2026 levels in roughly 6 months, so autumn 2026. Drops are always quick and recoveries are gradual. A drawn-out scenario, that is if the conflict continues further, a parallel to 2014 to 2016, a slow decline for a year or a year and a half and then recovery. The worst scenario, a new reality. Strikes continue to come in once every 2 months or so. There really are few alternatives. And one more thing that COVID showed, Dubai knows how to recover better than any other city in the world. They have money, they have vision, they have a marketing department at the state level. A couple of good initiatives and the situation will turn around faster than you can re-enter. Coming back to the question from the beginning, will Dubai's market be able to pull through this time? And how fast? My answer is yes, it will pull through. The base scenario, 6 months to return to February level. The worst, Dubai in a new reality with periodic tension. But the fundamentals will still remain, which made Dubai the best city in the region and one of the best in the world. And as Warren Buffett once said, the stock market, and real estate market I would add, is a mechanism for transferring money from the impatient to the patient. Don't panic and follow the strategy.